I'm Steve Brice, Standard Chartered's Global Chief Investment Officer. What a ride it's been since Liberation Day. US President Trump shocked markets by pausing reciprocal tariffs on over 75 countries for 90 days, while escalating tariffs against China. The flip-flop in US trade policy remains the primary driver of market volatility. Although partial rollbacks helped calm markets somewhat, there was still a lot of volatility. Bond yields have fluctuated due to concerns over stalling growth and rising inflation, while gold has trended firmly higher. A US economic soft landing remains our base case scenario, but the odds of a US recession have risen to 30% from 20% a month ago, in our opinion. President Trump's tariffs, even if they remained at the 10% base rate, will hurt growth and inflation this year. We expect major central banks to cut rates in the next 12 months, with the Federal Reserve in the US expected to cut rates by 75 basis points and the European Central Bank by 50 basis points. China is also likely to further ease fiscal and monetary policies to stimulate domestic demand and offset the deflationary impact of US tariffs on the Chinese economy. The Bank of Japan, on the other hand, is expected to hike rates further as a tight labour market fuels wages and inflation. Let's now turn to our Signature CIO strategies. After the sharp sell-off earlier this month, our strategies have recovered strongly. The income, conservative and balanced strategies are back in positive territory year to date, while our growth strategy is down a mere 0.3%, having recovered from being down over 8% at one point. So how are we building resilience in this volatile environment? We see equities and bonds as core holdings, but remain overweight gold. Within equities, we believe a balanced approach across major regions is sensible amid market uncertainty. US equities would still likely do well in a soft landing scenario, but we're also seeing increasing opportunities in European and Asian equities. Within bonds, developed market investment-grade government bonds should benefit from a softening of the bond yields in the slow growth environment. On currencies, we believe the sharp drop in the US dollar is potentially the start of a more prolonged decline. That said, the market backdrop is evolving very quickly, and tariff concerns are likely to remain an overhang on markets for some time. We are keeping a close eye on how these could impact consumption, investment, job creation, and of course inflation expectations. Although the US job market remains resilient, soft data elsewhere suggests waning business and consumer confidence and rising inflation expectations. As near-term inflation risks rise, there's a possibility for the Fed to delay rate cuts. Through it all, we try to filter out the noise, stay focused, and continue to look for opportunities, while ensuring allocations remain diversified across asset classes as well as geographies. Thanks for joining me for this monthly CIO Signature Strategy Update. I'll be back with more updates next month. See you then.